Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. We have a massive, complex task ahead of us today. We're going to be synthesizing the financial and operational health of, well, the three titans of the global nicotine sector.
That's right. We're talking about British American Tobacco, or BTI, Altria Group, MO, and of course, Philip Morris International, PMI.
And we're really trying to look beyond just the headlines. We're digging into the raw data from their latest reports and, importantly, the management commentary around it all.
That's absolutely essential. Our objective is to extract, every relevant numerical fact and qualitative statement. We need to bridge the gap between their financial performance, the hard numbers, and the strategic risks and the big transformations they're trying to pull off.
Especially that massive pivot towards smoke-free products, or SFPs.
Exactly. So what we want to give you is a clear, structured summary. We'll cover the financial highlights, any guidance adjustments, key segment performance, and crucially, the underlying regulatory pressures that are really impacting future returns.
Okay, let's start with British American Tobacco, BTI, and their Q1 2025 strategic update. If you listen to their management commentary, the tone is, well, it's definitely geared toward optimism.
Very much so. They keep calling 2025 their deployment year for new categories.
A deployment year. What does that actually mean in practice?
It's a year of aggressive deployment. Management seems genuinely excited about the innovation rollouts they're undertaking. They're promising an improved contribution margin from new categories, not just in the first half, but for the whole year.
So it's not just about volume.
No, what they're stressing here is quality growth progress. So they're not chasing volume at the expense of profitability. They expect these new innovations to really accelerate their revenue performance, especially in the second half of the year.
That focus on profitability and capital discipline. That feeds directly into their shareholder return strategy, right?
Absolutely. They confirmed an incredibly strong cash conversion expectation. They're projecting they will exceed 90% conversion again in 2025.
90%. I mean, that statistic is critical because it tells you the operational efficiency of the business is just rock solid, even with all the market turbulence.
And that operational strength gave them the flexibility for a pretty major capital move recently.
You're talking about the ITC stake.
The partial monetization of their ITC stake in India, yeah. That was a big strategic event that directly facilitated an immediate increase in their share buyback program.
How much did they bump it up by?
They increased the program by £200 million, pushing their total commitment for 2025 to a hefty £1.1 billion.
Wow.
And this isn't just, maintenance spending. This signals a real commitment to return value while they're also driving this transformation. This whole strategy is built on hitting their stated midterm algorithm goal in 2026.
And central to that midterm goal is reducing leverage. Their target is clear on that. They expect to be back within the 2 to 2.5 times adjusted net debt to adjusted EBITDA range.
Right, by the end of 2026.
By the end of 2026. Well,
correct. But even with that strong commitment to deleveraging, their guidance for interest rate costs is still pretty cautious. They've rounded it at about £1.8 billion.
That's a high number.
It is, and it reflects BTI's awareness of the continued volatility in global interest rate environments, especially around the 10-year bond rates they watch so closely. They're pricing in conservative refinancing estimates.
It's also important to remember their cash flow, right? It's always weighted to the second half of the year.
It is, and that's just due to the annual timing of their inventory purchases and their MSA, the Master Settlement Agreement payments. So you shouldn't panic if H1 cash generation looks a bit softer than H2.
Okay, now let's unpack the operational headwinds because BTI is facing. Well, it feels like a perfect storm of challenges, starting with the regulatory landscape.
Yeah, they are anticipating accelerating legal industry volume declines, and that's mainly driven by planned excise increases coming in September.
This is where that synthesis you mentioned is so important.
Exactly. BTI characterizes these policies as counterproductive. They're saying the excise increase is expected to further accelerate the decline of the legal industry volume, while at the same time, it's just bolstering the illicit trade.
And the illicit trade is already a massive problem.
It's huge. They estimate that illicit trade already represents over 75% of nicotine usage in some of their key markets.
75%.
So you combine the excise tax impact with that illicit trade growth, and they anticipate an impact on their 2025 group revenue growth of around 1%. And on their group APFO growth, that's adjusted profit from operations, basically their measure of underlying profitability by around 2%.
So you could draw a straight line from regulation to reduced shareholder returns.
A direct line. And if regulatory headwinds weren't enough, you have to throw in global currency complexity. They're battling transactional FX headwinds estimated at 1.5% for the year.
And the concentration of that risk is,
Yeah,
it's alarming.
it is. 65% of that FX impact stems from just three highly volatile markets: Turkey, Nigeria, and Japan.
Dealing with that kind of currency volatility requires extremely sophisticated hedging, and it puts immediate downward pressure on your reported numbers.
This perfect storm excise policy driving illicit trade and these volatile currencies, it's actively eating into their expected growth rates for the year.
Let's pivot then to the business segments. The critical balancing act between new categories momentum and combustible resilience. Starting with modern oral, Velo seems to be absolutely delivering on its promise.
It is. They're expected to deliver strong double-digit revenue growth.
And the numbers back that up.
The numbers are undeniable. They captured significant volume share gains, up 350 basis points, reaching 29.7% across their top markets globally.
But the real story is in the U.S. with Velo Plus.
That's the game changer. This new variant is driving triple-digit revenue growth, and it has achieved nearly a 12% volume share in April.
And that's up from what, about 6% a year ago?
Exactly, double the share it held just a year prior.
Doubling your market share in a year in a category that competitive, that demonstrates extremely effective deployment.
It does, and Velo Plus is now in around 110,000 outlets, so it's effectively covering over 80% of the modern oral value pool in the U.S.
And they're not stopping there.
No, management is targeting further expansion to 130,000 outlets by year-end. That signals they believe there's plenty of room for organic growth without sacrificing margin.
And what about capacity? Can they keep up?
That was an important check. And yeah, management said that despite this explosive growth, they are satisfied with their current manufacturing capacity. This means they can avoid major immediate capital expenditure, which lets them redirect that capital somewhere else, maybe to the buyback program.
Okay, so modern oral is a bright spot. Now let's look at vapor use, which is, well, it's a structural challenge in North America.
It is. I mean, BTI maintained U.S. value share leadership at 50%, which is a huge accomplishment in itself.
But the market itself is contracting for the legal players. Legal industry volumes are down mid-teens year to date.
And that mid-teens decline is really the smoking gun of regulatory inaction. It's driven almost entirely by the unchecked proliferation of illicit, usually flavored disposable competition.
So what's the company's outlook on that? Do they expect help from regulators?
They expressed some cautious optimism about recent leadership changes at the FDA's Center for Tobacco Products, but they explicitly stated they do not expect any meaningful positive impact from federal or state enforcement to curb illicit trade in 2025.
So not this year. It's just moving too slowly.
Far too slowly to affect the bottom line this year. So relying on slow-moving regulatory bodies isn't the plan. They're focusing more on state-level actions, noting that vapor directory and enforcement legislation has passed in 17 states.
But the financial implication is clear. Vapor revenue is expected to decline by mid-teens in the first half of the year.
And that decline is a direct function of the illicit trade, particularly in the U.S. and Canada. They're banking on an improved performance in the second half, driven by the phased rollout of their new premium product, Vuse Ultra.
Which just launched in Canada, right?
At the end of Q1, yeah. Their core strategy is to shift resources toward the most profitable segments within their vapor portfolio, trying to maintain margins even as the volumes are suffering.
This brings us to a really crucial point. The new categories guidance revision. They're expecting low single-digit revenue growth for new categories in the first half, basically anchored down by these North American vapor issues.
But they do expect an acceleration to mid-single-digit growth for the full year, driven by those innovation rollouts.
And this is where that critical insight you mentioned comes in.
It is. This really shifts the entire perception of BTI's transformation success. If you exclude the performance of the troubled U.S. and Canada vapor markets, BTI expects double-digit revenue growth for the full year in new categories.
Double-digit. So their global transformation is actually highly successful.
It is, but the lack of regulatory parity and effective enforcement in just two key markets is acting as a massive anchor on their reported revenue growth.
Okay, let's shift to the combustible business, the legacy cash generator. We heard a bit of a surprise here. The U.S. combustible business is actually performing better than originally expected.
Yeah, that's leading to a shift in their expected profitability from the second half to the first half. It's really a testament to strong commercial execution against what is an awful backdrop. They actually gained 10 basis points in U.S. market share.
How do they manage that?
Management credited it to sustained investments over the past 18 to 24 months. That includes increasing store coverage from 83% to 88% and expanding their sales force by 10%. They're just squeezing every drop of efficiency and share possible from a contracting market.
And just how contracting is that market?
The overall industry volume decline estimate is around 9%. But, and BTI provided this vital nuance, the decline is approximately 11% when you exclude the deep discount segment, which is a segment BTI largely avoids.
So they expect to significantly outperform that 11% decline.
Right, in the relevant premium and mainstream categories due to their aggressive commercial efforts and premium pricing management.
Before we leave BTI, we have to talk about that fascinating small acquisition, a flavored disposable vapor brand in the U.S.
It's an incredibly bold move.
It feels like they're acknowledging and testing the water of the very market segment that's cannibalizing their legal views sales.
They are. Management was explicit. They said this acquisition is purely for piloting and understanding the dynamics of the illicit market segment. They have no firm commercialization plan yet.
And they put some numbers on that market, didn't they?
They did. They stated the total U.S. vapor market size is estimated at $9 billion in revenue, and fully 7% of that value pool is already captured by these illegal flavored products.
So by piloting a product in this space, they gain valuable insight into what? Consumer behavior, supply chains.
All of it. Consumer behavior, the supply chain, the product characteristics of the segment that is currently destroying their legal margins.
So does this signal a willingness to maybe engage in that gray market if regulation continues to fail?
It signals preparedness for multiple outcomes. If enforcement remains slow, they have a playbook. If regulation eventually authorizes certain flavored products, they've gained months of understanding about how to optimize their strategy to compete directly with these currently illicit players.
It's a highly strategic, almost defensive acquisition.
Exactly. It's designed to inform their future offensive strategy. That is a phenomenal nugget of insight into how these companies are adapting to a market where regulation and enforcement are just clearly failing.
Okay, let's transition now to Altria Group, MO, the domestic giant. We're looking at their Q3 2025 detailed financial and segment review covering the 9 months ended September 30th. Altria's results are always defined by the unique volatility of the U.S. market.
And that volatility is stamped all over these figures, starting with the GAAP results. Net revenues came in at $17.43 billion. That's down 3.6% from the prior year.
And the cause of that decrease is a pattern we see across the industry, right?
It is a massive volume erosion, totaling a $1.944 billion impact. That was partially offset by their consistent pricing strategy, which provided a $1.327 billion tailwind.
They managed to tick gross profit up slightly, but the major headline in the GAAP results is that steep drop in reported earnings.
A huge drop. Reported net earnings crashed by 29.1% to $5.83 billion, leading to a reported diluted EPS decline of 27.4% to $3.45.
This is where we need to apply that critical thinking. That massive reported decline is not the whole story.
Not at all. It's almost entirely due to special, non-recurring items. If you look at the adjusted performance, which excludes these items, the picture is far healthier. Adjusted net earnings were actually up 3.6% to $6.966 billion.
And adjusted EPS was up as well.
Up 5.9% to $4.12. So management is arguing that the core operational business is growing, despite the top-line revenue challenges.
And one of the key adjustments is related to intangibles. Altria is now excluding the amortization of intangibles from its adjusted results. Is this just financial engineering, or is there a valid argument?
It's certainly a choice that warrants scrutiny. Management justifies it by saying the amortization related to acquisitions is inconsistent in size and timing, which makes it difficult to assess underlying operational performance.
But critics would argue something else.
Of course. Critics would argue that by excluding amortization, they are artificially boosting their adjusted earnings metric, especially right after a major acquisition like NJOY. It's a gray area, but for you, the key is understanding the size of that adjustment to really assess the underlying profitability.
The major special item driving that gap collapse was the non-cash goodwill impairment, a stunning $873 million for their e-vapor unit, NJOY.
This impairment requires serious context. This is nearly $1 billion disappearing based entirely on a single regulatory ruling.
What triggered it?
It was triggered by the U.S. International Trade Commission, the ITC, issuing an exclusion order and cease and desist orders. These prohibited the importation and sale of the NJOY ACE product in the U.S., effective March 31st, 2025.
Wow. So that one regulatory block combined with higher projected commercialization costs for NJY's other products.
It forced Altria to radically lower its future revenue and volume projections for the entire e-vapor unit. It demonstrates the immense, instantaneous risk of the U.S. regulatory environment. One stroke of the pen and almost half of the brand's goodwill is wiped out.
The regulatory body provided immediate material financial pain.
Precisely. Post-impairment, the carrying value of that goodwill was reduced to $895 million. That remaining figure suggests Altria still has some hope for the NJOY brand, but the impairment is a profound failure in their new category strategy.
And there were other costs, too.
Yes. They also recorded $43 million in exit and implementation costs related to an internal organizational initiative during Q3.
Let's move to the segment deep dive, starting with smokable products. Adjusted OCI, and for Altria, that's operating company income, that increased 2.5%.
Right, to $8.421 billion over the 9 months. And that small profit growth, despite the massive decline, is the definition of Altria's enduring business model. Their pricing power remains just relentless.
Because the volumes were terrible.
Staggering. Domestic cigarettes shipment volume decreased by 10.6% over 9 months, which is significantly worse than the estimated industry decline of 8.5%.
So they're losing volume and they're losing share.
Yes. Marlboro retail share decreased 1.1 percentage points to 40.8%.
So how do they grow profit in that environment?
By hitting the consumer with price increases multiple times in 2025 alone. They raised the price of Marlboro by 17 cents a pack on January 19th, July 20th, and October 12th.
And then another one.
And then by another 20 cents a pack on April 13th. That's 4 major price increases in 10 months. Premium brands saw even steeper hikes. This constant testing of consumer tolerance is how they offset that volume erosion.
That volume loss is accelerating. Let's look at oral tobacco products. Revenues here barely budge, up only 0.6% over 9 months.
And this segment illustrates the short-term pain of transition within their own portfolio. Higher pricing was completely negated by a negative $180 million impact.
And that's from lower shipment volume and an unfavorable mix. Let's unpack that.
Unfavorable mix means that while their next-gen oral product, on pouches, is growing, its volume share is increasing relative to their traditional high-margin, moist, smokeless tobacco products like Copenhagen and Skoal.
And on has lower margins.
Exactly. So shifting volume toward it hurts their overall revenue mix in the short term, even as they transition to SFP.
The restated market share numbers really confirm this shift. Total oral tobacco retail share dropped 4.6 percentage points to 32.9%.
And the traditional categories are just collapsing. Copenhagen share dropped 3.5 percentage points to 15.8%. Skoal dropped 1.6 to 6.1%. The white space is being filled by On, which increased its share by 0.8 percentage points to 8.7%.
So the transition pain is clear.
Very clear. They are losing share and volume faster in the high-margin segment than they are gaining in the lower-margin replacement segment.
The regulatory environment section really provides deep context for Altria's biggest challenge e-vapor competition. The company estimates that illicit flavored disposable e-vapor products now represent more than 60% of the entire U.S. e-vapor category.
That 60% figure is startling, and it fundamentally explains the NJOY impairment. Altria stated explicitly that despite increased federal enforcement, these actions have not significantly impacted the volume of these unauthorized products.
The market is just completely distorted.
It is. It's preventing authorized players like NJOY from gaining traction, regardless of their capital investment or marketing.
On a positive legal note, they did achieve a massive reduction in future liability exposure.
A huge one. the number of e-vapor cases pending against Altria decreased significantly, from over 5,000 in 2023 down to just 16 as of October 2025.
That's an immense risk mitigation achievement.
It is, primarily due to settlements in the multi-district litigation lawsuits. It cleans up their balance sheet and dramatically simplifies their legal environment, allowing management to focus on transition rather than defense.
Finally, their shareholder strategy. The board showed strong confidence, authorizing a new $1 billion share repurchase program in January, which they then expanded.
Expanded by another $1 billion in October, bringing the total commitment to $2 billion.
And they've been active.
Very. Over the 9 months, they repurchased 12.3 million shares at an aggregate cost of $712 million, an average price of $58.08. This aggressive allocation, even with that impairment, signals management believes their stock is undervalued.
Okay, our third giant, Philip Morris International, or PMI. This presents a unique landscape, really defined by its successful global transformation and massive scale. We're looking at their Q3 2025 progress.
And PMI's figures tell a story of successful growth, really powered by their smoke-free portfolio. Consolidated net revenues reached an impressive $30.286 billion over 9 months.
That's a 7.5% increase.
It is. Operating income surged by 13.6%, or a very healthy 11.6% excluding currency impacts. Diluted EPS was strong at $5.89, up significantly from the previous year.
Their global reach also introduces some interesting currency dynamics.
It does. PMI reported a favorable impact of 2 cents per share from currency fluctuations over the 9 months. That was driven primarily by strength against the euro and Egyptian pound, though it was partially offset by a negative impact from the Swiss franc.
And if we look at volume,
PMI's total shipment volume for the 9 months increased by 1.8%. And the engine driving that growth is clearly the smoke-free product volume, which was up 14.3%.
and here's a crucial point. Their cigarette volume declined by only 1.3% internationally.
Which is a much more manageable decline rate than what Altria is seeing in the U.S.
Their guidance reflects continued confidence in this trajectory. Full year 2025 guidance projects total volume growth of around 1%.
And SFP volume growth is guided between 12 to 14%, although they do expect to land in the lower half of that range. Cigarette volume decline is projected to be around 2%.
This relative stability in the combustible business gives PMI a lot of breathing room to fund the transition.
It does, and the capital expenditures reflect this focus. Total debt increased to $50.1 billion, and they expect CapEx to be around $1.6 billion in 2025, with the vast majority supporting their SFP manufacturing and global rollout.
And PMI is rewarding investors for their patience. The Q3 dividend increased by a robust 8.9%.
Right, to $1.47 per share, bringing the annualized rate to $5.88. That's a significant statement about the sustainable cash flows from their transformation model.
Let's move to the smoke-free portfolio itself. SFP net revenues reached $12.5 billion over 9 months, a 16% increase.
This is where PMI truly differentiates itself. Their core heated tobacco units, or HTUs, adjusted in-market sales volume increased an estimated 14.6%, helping HTU share climb half a percentage point to 5.8% of the total international market.
The U.S. story, tied to the ZYN nicotine pouches they acquired, provides a massive strategic advantage, particularly in regulatory validation.
A huge advantage. The FDA on January 16, 2025, authorized all 20 ZYN nicotine pouch varieties currently marketed in the U.S.
And that's a landmark moment.
It is. The FDA's conclusion that ZYN products pose a lower risk of cancer and serious health conditions than cigarettes is just invaluable. It gives ZYN a scientifically substantiated competitive moat in the U.S. market.
Meanwhile, their flagship product, IQOS, is still undergoing its Modified Risk Tobacco Product, or MRTP, renewal process with the FDA.
Yes, the Tobacco Product Scientific Advisory Committee met on October 7th to review the data. While the decision is pending, PMI believes it's permitted to continue using the modified exposure claim until the FDA issues a final decision. It just highlights the need for continuous, costly regulatory engagement.
Now for the non-cash and litigation charges, which underscore those international regulatory risks. Let's start with the German excise tax charge.
PMI recorded a significant $176 million pre-tax charge in Q3. This relates to German authorities classifying their Turia heated tobacco consumables as traditional cigarettes for excise tax purposes.
And they withdrew their appeal.
They did, forcing the charge. And we have to remember, this comes on top of the massive €721 million, about $751 million payment they already made in January related to the German HTP supplemental tax surcharge, which is still under a separate appeal.
It's a clear warning sign about how governments are aggressively targeting these new products for taxation.
Once they gain market acceptance, absolutely.
Second, PMI recorded a non-cash charge of $146 million on an investment in their wellness and healthcare segment.
This impairment was triggered by a reevaluation of the fair value of that investment. The team basically determined a lower likelihood of success for certain projects in development. It confirms that expanding beyond nicotine is proving to be difficult and expensive.
Third, and perhaps the most complex entry, is the resolution of the Canadian litigation settlement involving their subsidiary, RBH.
A huge settlement. The aggregate global amount reached 32.5 billion Canadian dollars, or about 23.1 billion US.
But the accounting impact for PMI was positive.
It was, which is strange, right? In Q3, they recorded $303 million in pre-tax income. This gain reflects a dividend of 750 million Canadian that was paid, net of the corresponding decrease in the carrying value of the RBH investment. It's a complex accounting positive stemming from the legal resolution of a gargantuan historical liability.
Finally, we have to discuss geopolitical risks, which weigh heavily on PMI's balance sheet, specifically Russia and Ukraine.
The figures are staggering. Total assets in Russian operations amount to approximately $4.5 billion as of September 30th.
And critically, a lot of that is cash.
Approximately $2 billion of that is held in cash and equivalents, mostly denominated in Russian rubles. Ukrainian operations held about $0.7 billion in total assets.
Holding $2 billion in rubles, a currency subject to strict capital controls, that introduces immense realization risk.
It does. If they can't execute a divestment, which is proving incredibly complex, they risk material impairment.
What's the realistic path to exiting Russia and realizing that value?
The path is narrow and very costly. Any buyer would demand a massive discount. Furthermore, if they can't repatriate that cash due to capital controls, that $2 billion essentially becomes trapped capital, perpetually exposed to local inflation and devaluation risk. This is arguably the largest single risk exposure on PMI's balance sheet right now.
Okay, we've dissected 3 highly detailed reports. Let's move to our comparative analysis, focusing on the total return potential and risk profiles of Altria and BTI.
Starting with shareholder returns, the dividend narrative is remarkably similar. Both companies showed cautious, low single-digit growth, really reflecting industry pressure. Altria declared a Q3 payout of $1.06 per share.
And that's a year-over-year growth rate of, what, just under 4%?
Plus 3.92%, yeah.
And BTI landed right next door, declaring a total 2025 payout of $3.978 per share, an increase of 3.89%.
So when dividend growth rates are almost identical, investors need to look elsewhere for differentiation.
And that differentiation often comes down to valuation and capital return beyond just dividends.
Exactly. Altria is frequently cited as having a more attractive valuation based on a metric that value investors love, the PEGI ratio.
Let's properly unpack the PEGI ratio for you. It's the price-to-earnings ratio divided by the sum of expected earnings growth and the dividend yield. Legendary investors, like Peter Lynch, favored companies where this ratio was below 1.
And Altria is currently cited as having a PEGI ratio of only about 0.9.
That 0.9 reading is a strong signal of high total return potential relative to its current valuation and yield. And then there's the buyback.
Right. Altria's expanded share buyback activity, the new $2 billion program, is seen as comparatively more robust for total capital return potential.
But wait, BTI also increased its buyback to £1.1 billion after that ITC stake sale. Is there a fundamental difference in where that capital is coming from?
Yes, and that structural difference matters a great deal. BTI's buyback increase was directly funded by an asset sale. It was a strategic one-off capital event.
Whereas Altria's is funded by operations.
Altria's $2 billion program is funded by relentless ongoing operational cash flow generated primarily by its pricing power in the domestic combustible market. Altria is using its stable, albeit shrinking, cash cow to fund returns. It signals a real difference in long-term capital allocation philosophy.
Now, when we transition to risk concentration, the narrative shifts sharply back in BTI and PMI's favor. Altria's single market concentration risk in the U.S. is its key vulnerability.
Absolutely. The ongoing threat of a potential nationwide menthol ban, for example, would disproportionately damage Altria. Its entire focus is the U.S. market. BTI and PMI, with their geographically varied operations, would feel the ripple effect, but they have immediate hedges in other international markets.
Yeah, we're already seeing this risk concentration manifest in their new category execution. The proliferation of illicit vapor products in the U.S. is a shared risk, but it impacted Altria's NJOY plans so acutely that it forced that massive impairment charge.
That's the crux of the comparison. Altria cannot mitigate U.S. regulatory failures. You contrast this with BTI. While its U.S. and Canada vapor business is suffering, its global new category growth, excluding those two markets, remains double-digit.
Geographic diversity allows BTI to absorb the shock.
It allows them to absorb the shock of regulatory inaction in one market and sustain its transformation momentum elsewhere. Altria simply doesn't have that option.
And PMI, on the other hand, is benefiting from regulatory validation. The FDA's finding that ZYN poses a lower risk of cancer is a crucial strategic asset.
It's a regulatory endorsement that MO and BTI are still chasing for their own SFP portfolios. PMI's ability to drive over 14% growth in HTUs internationally further validates their diversification strategy. It proves the strength of their technology deployment outside of the uniquely volatile U.S. landscape.
So the knowledge nugget here for you is that investing in this sector isn't just about predicting volume decline anymore. That's inevitable.
Right. It's about betting on which management team can most efficiently pivot their portfolio away from combustibles and successfully navigate this increasingly turbulent global tax and regulatory environment.
And avoid the financial landmines, like the NJOY impairment or the German excise taxes.
We've seen these significant non-cash charges. Altria's $873 million impairment, PMI's tax and legal charges that underscore the volatility. But you could argue these are necessary costs of transformation. The SFP growth BTI's Velo, PMI's ZYN and HTUs is the undeniable future.
Yet despite that transformation, we have to acknowledge that pricing power in the traditional combustible segment remains a crucial lever for profitability for all three of these giants, even as volumes decline by 9% or more.
That's the critical tension here.
How much longer can those consistent aggressive price hikes offset volume attrition before the underlying math just breaks down completely?
That is the question that defines the sector's immediate future. Altria, for instance, offset a 10.6% volume drop with relentless pricing. If that volume decline accelerates to, say, 15% next year, the price increases, which are already extremely aggressive, might not be enough.
And that would force a massive pivot in capital allocation.
It would, perhaps away from buybacks and into more desperate, high-risk new category investment. The entire sector is balancing on this tightrope, selling a declining product at a higher price to fund the growth of the product that is ultimately intended to replace it.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.